So Seth, two things before you start. What was your big takeaway from yesterday's CVAR?
The economic update.
Yes.
Yes. So that was a great presentation. Mr. Levine, I think is his name. He's the chief economist for the California Association of Realtors. Super smart guy, packed tons of information into the next hour or that hour. One of my big takeaways was the tool that he presented that CAR has put together on their webpage. I was going to make a Facebook post and I'll share it with this group after. I'll send you an email that you can distribute out. But they have a tool that shows different interest rates and what that does for purchasing power. And it's really neat. You can point to the county that you want, and it shows you the amount of inventory that a person based on their income and the current interest rate qualifies for. So if somebody's making $100,000 a year and the interest rate is 3%, you can see, okay, in San Joaquin County, there's 800 homes that they could qualify for up to $800,000. Well, if you change that rate to what it is now, 5.5%, and keep their salary the same, then that reduces their buying power to about a $500,000 house. And it means there's only 200 and something houses available. So it's a really powerful tool to look at any county in the state and see what the impact of these different interest rates are. The other takeaway is interest rates are still going up and housing is staying strong because of supply and demand. So those are the takeaways.
Awesome job. Did you talk about the rental market going up?
The rental market, he did talk about the rental market going up. Yep. You know, there's no foreclosure crisis coming. There's all this equity that people have. He talked about loan quality and the strength of loans, and people, if they can't make their payments, they're going to sell because they have equity. So there's, you know, sellers that may be coming on as the economy starts to shift and people lose their jobs, unemployment goes up, but that's just going to strengthen the rental market. People have to live somewhere, and rents are increasing even faster than home prices.
There we go. I thought so.
Yep.
That's all the data we keep reading. Okay.
Yeah, exactly.
Seth, take it away.
All right. Thank you for having me. I wanted to share my screen because I have just a little bullet point that I wanted to go through. So let me make sure I have the right screen here. Okay. So the topic that I wanted to cover today is what non-QM loans are. I know everybody's out at open houses again. We see this big increase in inventory coming back, and all of you are out there talking to buyers, whether it's at open houses, whether it's on the phones, whatever it is. And there's been a lot of getting away from these creative loan ideas over the last couple of years because the buyers have been so strong, you know, cash offers, big down payments, strong credit, people with great jobs moving out to the Valley from these more urban areas, San Francisco, Silicon Valley. And the quality of the buyers that we've had has gotten us kind of pigeonholed into standard types of loans. You know, there's conventional, there's FHA, which has been really difficult in these last couple of years because it's hard to compete to get FHA offers accepted. Even VA, I talked in another presentation I gave to you guys about some of the VA myths, but still the sellers have been in a position to really select the most qualified buyers with these big down payments and great credit profiles and already upfront underwritten and all that. And it's gotten us away from the lenders. It's gotten the lenders away from doing a lot of these creative loans that we used to do. And these have crept back into the market as there is a bigger need for these now. So one of the big things that I focus on is self-employed people. So we'll talk about that a little bit, but I just wanted to go through some examples. So you're armed with the information that you need to talk to buyers that may be asking about all these questions. So non-QM means non-qualified mortgage. A qualified mortgage is basically something that fits the Fannie and Freddie requirements, meets the DTI requirements, full documentation, W-2 job, typically full tax returns, all those kinds of things. So when I say non-QM, it's anything that falls outside of that category. And there's different lending rules and different lenders and a lot more flexibility because they're more human underwritten instead of desktop underwriter and just sticking to the requirements. A lot more exceptions are made. So first one on here is Condotel, not very popular in our area. I helped a few people last year buying condotels in Florida. That's something that's managed by a professional company. It's a condo near Disneyland or something like that, that falls in a different category than a regular condo because it's more rented out like a hotel. So we don't really have those here, but I just want to throw that up there to show you the different types of properties that non-QM tends to cover. Another one is foreign nationals. Now, I know in our area, there's a lot of H-1B workers. We have a lot of investors coming from out of the country. I helped some people from Canada, some people from the Middle East that were buying property here in California, and they need programs for foreign nationals, non-US citizens. They're not working here. They just want to invest in real estate. So we can do foreign national programs up to 80 LTV. That means they need a 20% down payment. There's usually no credit requirement. Foreign credit is very different than US credit. So, there's, as long as they're putting 20% down and they can show that they're not living in the country, which is kind of a weird requirement, but to be a foreign national investor, you have to show that you're not living in the country. It's just an investment.
Hey, so two things. Do they need a certain visa?
No, because they're not working here. So that's part of the requirement. If they're going to be working here, it changes things. They're going to be a resident or they're going to get a visa and they have a job. There's programs for that too. And I'm glad you brought that up. So if a straight foreign national, somebody that just lives in another country and wants to invest in the US, buy a rental property or whatever. So this is the program that would cover for that. If somebody's moving here for a job, they can have a very difficult time getting a loan too. And most of the stuff you'll find online, the information that's out there will say that you need to have 2 years of work history in the US or 2 years of residency. So there are programs that allow people. I helped somebody in Mountain House last year. They were moving from Canada here. They wanted to buy, they didn't want to rent for 2 years. So they were able to buy a house. They needed the 20% down payment, but they could show that they had a job here and they were moving here. So there are two different categories, but a lot of the same requirements, that 20% down and creative credit proof.
Can you let people in, Seth?
Oh yeah, I'm sorry. I get distracted. Okay.
And then other is, who is using that? Because at one point, Canadians were buying here, and then we were starting to see a lot of people from the Middle East. China was doing it for a long time. Who else is buying?
So China, in my experience in the last year, has really slowed down. There's restrictions on how money can come into the country. Obviously, from certain countries, there's friendly nation status with different countries. So Canada is the big one. It's not a huge volume, but there's a couple of loans that I've done for people coming from Canada that want to invest because they're either planning on moving here. An interesting situation that's happened a couple of times is I've known people in Mountain House, that's where I live. I've known people there that they can't get their visa renewed for whatever reason. They have to move back to Canada and either want to keep their house or buy a property here and they're moving back to Canada, or they're getting ready to move back. Like Canada is the big one that I've seen just because of our location and where people are coming from here. I think down in Southern California, there's a lot more international investment happening. But I know China's kind of been off the table. But I have seen some from other Middle Eastern countries and Canada, especially.
Good to
Okay.
know.
So there are programs to do credit scores down as low as 350, which is incredible. But there's always a mitigating factor with these types of programs. And I've talked about it before. There's really 3 pillars of the mortgage qualification. It's credit, income, and down payment. So, if a lender or an investor is going to take on one of these loans that has a super low credit score, they're going to figure out what's going on, what the real risk is. It's ability to repay and willingness to repay is what investors and lenders that are loaning out this money are looking at. And they're always going to require a bigger down payment. So these are like 30, 40%, could be hard money. But I just want to throw that out there. If people are saying they can't qualify because of their credit score, number one, there are programs, especially if they have a down payment. And number two, there's plans to get them where they need to be. So I don't want any buyers to walk away saying I have a low credit score. The thing that I always tell people, it's if not now, then when? We can get you on a path to get there. It may take 2 weeks, 2 months, 2 years, but it's a matter of helping people get the right information, because people that try to do their own credit finagling, their own information that they find online to try to help them improve their credit score, it's wrong 90% of the time. So the first step is to have them apply and figure out what the right path is if they do have a low credit score, but there are options if they have the down payment saved. This no income self-employed is a big one that I've been doing lately. A lot of people that have had a lot of equity, done a cash out refinance, or just sitting on cash over the last couple of years, and they're self-employed. If they want to buy an investment property, I've seen a lot of this down the valley in California, Visalia, 29 Palms, a lot of the lower entry point areas that people are buying investment properties. These no income self-employed programs are really good. If you're buying an investment property, especially, you can just put 20 or 25% down, depending on the credit score, and you're only qualifying for the mortgage based on the rental income of the property. It's called a DSCR loan. we can get into the technical part of what all that means. There's ratios that they have to meet, but they're very easy to qualify for. And it goes so quickly. It's almost as good as a cash offer. If we have people in these programs that we have vetted and ready to go, we can close these very quickly. Foreclosure, BK bailouts, those are definitely there. High DTI. So the DTI is the debt to income ratio. If
go back to the foreclosure and BK bailout.
Sure. Yeah. So there are loan modification types of programs that we can help people if they are in foreclosure, or if they've had a recent bankruptcy, if they're in a bankruptcy. But the key to these right now in this market is the equity that people have. So the home values have gone up so much, there's zero reason that anybody should be giving the keys back to the bank, that anybody should be going into foreclosure. They should be selling that property if they need to, or, if they're in a bankruptcy and they've got all this equity, they may be able to get a cash out refi, pay off the bankruptcy and keep the house. So there's a lot of people don't realize, I'm glad you stopped me, Ron, because this is an important tool for us to use with buyers that think, they're out shopping for houses. They want to get excited, but they get discouraged. Oh, I'm in a bankruptcy, or I had a recent bankruptcy. There's programs you can get an FHA loan if you're in a bankruptcy, and you can get an FHA loan if you're a homeowner. The home mortgage is in the bankruptcy. If you are making consistent payments on that bankruptcy, we can petition the judge to allow you to refinance and improve your financial situation. Instead of being in a 3-year bankruptcy repayment plan or whatever it is, whatever the agreement is, you can use the equity of your home to cash out. So there's 2 categories. There's people that are in bankruptcies that own homes that their mortgage went into the bankruptcy. That's the best situation for people right now. If they think that they're stuck for 3 years, they can't do anything, and they're trying to improve their credit, we can use the home equity, do a cash out refinance, and help them pay off this bankruptcy. The other thing is, if you've had somebody that has been in a bankruptcy, had to sell, they may be able to qualify to buy a home sooner than they think. So it's always worth the conversation. And again, there's just so much misinformation out there that you'll see 2-year rules and 7-year rules and all these other things about post bankruptcy when people can apply for mortgages, but there's really other solutions that either people don't know about, or maybe they're a little more difficult and they don't want to pursue, but there's solutions out there for most everybody.
What about those people that are in forbearance?
Forbearance is a good topic too. So many people, I mean, it sounds like a lot, but really it was only like 8% of the market. The economist yesterday, he went through how many people were actually in forbearance and what those numbers look like. A lot of the people in forbearance, they kept making payments. So there's no impact on their credit, no impact on their qualification. Some of the people did a loan modification at the end of the forbearance. That's the biggest category, is that people didn't make their payments and then they negotiated with the lender to add those missed payments to the back end of their loan and did a loan modification. It's a legal document. It extends their loan out for maybe another year, adds that money back in that they didn't pay. The biggest thing to think about on forbearances is they have to be out of the forbearance. They usually can't do a refi or purchase another home if they're in a forbearance. They have to be out of it. And if they're in a trial period, then they have to make 3 payments, or they have to have a completed loan modification that gets them back into a current status. So that's, again, there's programs for all these people. It's just a matter of knowing what the requirements are and getting them connected with somebody that can give them the truth, that doesn't either just say no outright, or doesn't have the right information to get them in a plan, and everybody gets frustrated. So forbearances are a big thing right now because there were a lot of people, but there are ways to get those people financing as well. A lot of it is what I see is, for you guys, if it's a sell and buy situation, if somebody's in a forbearance and they're getting ready to list their house, then, I talk a lot to listing agents. As a lender, people ask me why I want to talk to listing agents. It's because every seller is a buyer at some point, right? So you may have these financing questions as you're talking to people and on listing appointments. People aren't ready to list, and they have concerns because maybe they're in a bankruptcy, or maybe they did a forbearance and they don't think they can list their house and sell it. They think they're stuck for another year, whatever, but they want to move. So these are tools that you can give them the right information and help them get what they want, instead of having to wait for some timeline that they have in their head or they read somewhere that's wrong. So back to the 55 DTI, most loan programs, it's a 45% DTI, sometimes 50. With FHA, we can go to 55. This is the debt to income ratio. So this means as home prices have been going up, interest rates have been going up, the monthly payments are higher, obviously. So people are really squeezed if the incomes haven't been keeping up and their ratios may be too high to qualify, but there are programs that allow exceptions. A lot of that, again, remember those three factors: credit, income, and down payment. So if they're if the bank, the lender is going to allow a higher debt to income ratio, then they may need to have a higher credit score or more down payment or something like that. So all these things work together. There are programs for no reserves. That's a big one when it comes to jumbo loans. The San Joaquin County limit is $647,000. The median home price in California, again, from the presentation yesterday, is $900,000 now. That means 50% are higher than that and 50% are lower. We know in our immediate area, Tracy, even Manteca, Mountain House especially, but in San Joaquin County, we always run into this loan limit, right? 647,200. So there's programs that allow people to be in the jumbo loan category, which is over that 647 amount on the loan, that may not require reserves. The biggest one that I do is a combo loan, right? They were really popular years ago, the 80-10-10s. It just depends on how you set up the structure. You do an 80% first loan and you put the rest of it into a second loan. That way there's no PMI, but they can still do 5 or 10% down by having a second loan and not have a reserve requirement. So again, these are all objections that people have that you can help overcome if you have the right information. Somebody says, I'm trying to buy this home. It's $1 million. I only have 10% down and I don't have reserves. I've been in the country for 6 years, but I don't have a big 401k to use as reserves, that kind of thing. There's programs to help those people out. Gift of equity is, I've done a few of those lately. There's, maybe older folks that have given the house to the kids that want to, there's a family situation where they're trying to do a sale of the house when one group of siblings has been living in it or something. So gift of equity is usually between family members to allow like the kids or siblings to buy the house without having to come in with a down payment. Whoever owns the house, they can give a 20% gift of equity or whatever it is to remove the down payment requirement. So this usually applies for family situations so that people don't have to come in with money, but they can do an ownership transfer through a sale. FTHB is just first-time home buyers. Sometimes lenders have strict requirements on what they can do for first-time home buyers versus experienced people. A lot of this comes to investing. I had somebody buy an investment property who was renting. They still wanted to keep renting, but they wanted to buy an investment property. I call that buy your second home first. Buy that home that you may move into someday. Get your investments going, start building that equity and wealth, no matter where it is. If you plan on moving somewhere, you can buy a property as an investment. Some lenders have issues with, if you've never owned a property, to buy an investment property sometimes can be difficult, but there are programs for that. And then no trade line requirements for people that don't have a full credit report or a credit score. ITIN buyers would fall into this category also. That maybe somebody who has an ITIN and no real credit history. There's alternative ways to establish credit history. A cell phone bill, auto insurance, something that shows a consistent payment history. If there's nothing on the credit report, we can establish an alternative credit history to show the strength and the willingness to make payments. So that's kind of the non-QM category. Does anybody have any specifics or weird scenarios, categories that I didn't cover here that have come up or you have questions about? Okay. The other thing that I wanted to talk about is the objections that you guys are hearing at open houses or on the phones when you're talking to buyers. I've got a couple in mind, but if there's anybody that wants to give me one of the objections, and I can tell you how I handle it from the lending side and give you some of the knowledge and the tools to overcome some of these objections. And does anybody want to jump in with an objection that you're hearing from buyers when you're on the phone or at an open house?
Most of the objections that I hear are interest rates are just crazy high, and I'm just going to wait until things calm down.
Okay, that is a valid concern, and that's definitely what you're seeing in the media, and people are spinning it as a reason to wait to buy homes. But do you know what's going up just as fast as interest rates? Is the prices of homes. Exactly. So there's two things that you're chasing if you're waiting for interest rates to come down. The line that I always tell people is the home is the product and the financing, the mortgage is the tool to get you there. So interest rates are going to go up and down. It is what it is in the market. We can't control that. Inflation has an impact. The markets have an impact. All these things are driving interest rates, which we see go up and down. The good news is that as inflation starts to come down, which it should in the next year, you'll see interest rates start to come back down. The predictions are next year, but in the meantime, rates are still predicted to go up. So if we're at a 5.5% rate right now, The experts are all saying we may get to a 7% by the end of the year. What that does to your buying power, if you wait till the end of the year, that really reduces the amount that you can pay because the monthly payment is going to be much higher. But the other thing is that home prices are still expected to increase over 10%. So if you're looking at a $600,000 house, that means that house is going to be $60,000 more next year and also increase your payments. So you're chasing two things. Do what it takes to get into the house now. You can always refinance later. So that's the talk that I usually give people when they're concerned about interest rates. What's
Got it.
another one?
Down payment.
Okay, good. Yeah, down payment. So it's been a tough market over the last couple of years for people that don't have a down payment because it's been a seller's market and sellers have been able to pick the offers that have high down payments. You know, they're really being picky about the risk that they want to put into accepting an offer with financing. Now that we're getting into a little bit more inventory and there's more competition, people with lower down payments are having a better shot, in my opinion, of getting their offers accepted. So if you don't have a big down payment, there are down payment assistance programs. It's really important that you understand what the strings are that are attached to that. Free doesn't always mean free. If you're getting money from a state program or a county program, something that's giving you down payment assistance, there are usually second liens involved. Maybe it's a 0% second lien that gets put on the house and you have to pay it back when you refinance or sell the house, but some of those are forgivable. The other thing is the interest rates are typically higher on the down payment assistance programs. So it's important that you talk to the lender and understand what the give and take is. The best thing to do, if you can, is to work with family to get a gift for the down payment, because that way you're still going to qualify for the best interest rate. But if you need to, it's a great tool to use for down payment assistance. Again, getting into the house and start having that home equity appreciate for you can make up for some of the downside of going with the down payment assistance programs and taking that higher rate. You're still going to do better in the long run by starting to build that home equity. So there are programs. Of course, the VA program is the best one with no down payment required. Always make sure you're mentioning that. There's so many veterans and qualified people in our area, especially in these Central Valley counties. There are just a huge number of veterans that don't always understand what their benefits are. So 0% down payment for veterans. And then there are CalHFA and GSFA. Those are the two main down payment assistance organizations for California that can provide up to 7% down payment assistance. So that could get you your 3% down payment or 5% plus closing cost assistance as well.
What's GSFA?
GSFA is Golden State Finance Authority. So it's just like CalHFA. A lot of people get confused with CalHFA because it sounds like FHA, but it's not. It's HFA. So that's the California Housing Finance Authority. And both of those are grant programs. They get grant money from the state to assist home buyers and to allow more home ownership opportunities for either different categories. They've got programs for teachers, firefighters, first responders, all that kind of stuff. But their main mandate is to increase home ownership in the state of California. And they do that through grants and then through these programs where they charge a little bit higher interest rates for giving these down payment assistance programs. They can help more people. But GSFA is similar to CalHFA.
What is the one down payment assistance program you just go, this is my cup of tea, I can do this all day long?
So I like the GSFA program. And I especially like their grant programs. That's a true grant. It doesn't come with any strings attached. You don't have to pay it back. And it's for anybody that works in a first responder category. So you could be the IT guy at a hospital and qualify as a healthcare worker. You know, you could, they're very flexible on their programs. So they have the regular down payment assistance programs where they'll give 3 or 5% that you have to pay back when you sell the house. It's a second lien. Those kinds of things. But the ones that are the true grant programs where you can get a 3% grant for these groups is the best one. And they're pretty easy to work with. Their requirements are flexible. Some of the programs have income requirements, which again, our very special San Joaquin County has some difficulties because we're lumped in with Stockton and Lodi, and that drives our average annual income down quite a bit. So the high earners that are in the western part of San Joaquin County and Tracy, Manteca, Mountain House, you know, they're always going to be over the limits to qualify for some of these down payment assistance programs. In our county, it's $70,000 for a 4-person household. is the area median income, I think. And some of these programs have to be below 80% of that. So basically, if you have to be making $60,000 to qualify for some of these programs, but if you're only making $60,000, you can only qualify for a $350,000 house with interest rates where they are now. So sometimes the numbers don't pan out, and that's a reason USDA doesn't work in our area also, is because they have these strict income requirements, and it bumps the purchase price down that people can qualify for based on this lower income that they have to qualify for these programs. So that's, I don't do any USDA. Sometimes they work out in Patterson, but in our specific area, Tracy, Mountain House, Manteca, they don't typically work.
I have a question. A lot of people shy away from VA loans because of the strict requirements to get
So I've got a document that I've shared with the group. I think I sent it to Casidra before, or I'll send it to you again. It's called the a VA myth sheet, and I send it with every offer and pre-approval letter that I present for VA loans. I have this extra sheet that says VA myths, and it's all the common objections. You know, the appraisal's harder. That's the main one, right? The other one is that the VA can't pay for repairs or certain fees. That doesn't apply in California anymore. That went away years ago. So there's a lot of these things that people have in their minds that are just old or bad information. That's important that we educate people on, because yes, it does require a different appraisal, similar to an FHA appraisal. But it's really in an area where the homes aren't 100 years old. It's really not anything to be scared of. And the biggest thing that used to come up before with these appraisals was, okay, there's inspections. There's a termite inspection required also, is the repairs that get called out in the inspections. It used to be, and it's been years, like I'm talking 15, 20 years, that it used to be that the veteran could not pay for those repairs. Now anybody can. Yeah. So that's the biggest thing. Are you hearing other objections, Chrissy?
No, a lot of the agents that I work with a lot of VA loans, and a lot of the agents immediately shut me down because they say, you know, we don't want to have the seller pay for repairs. And I educate them and tell them, well, my client can pay for his repairs if, he agrees to it.
Yeah. Unfortunately, veterans aren't a protected class, right? There's so much talk about fair housing and anti-discrimination. It would be great if people started to have the mindset of veterans who've earned this. I'm a veteran too, so I'm pretty passionate about it, but veterans who have earned this benefit shouldn't be discriminated against when it comes to buying a house, whether it's 0% down payment or these other objections that people have with inspections and appraisals. It's hard, it's education. And there's a lot of agents that have been around a long time and have not seen what the changes are, not kept up with it. So the best we can do is educate them. But I get pretty passionate about it. These folks that have earned this benefit, that you're shutting them down from not being able to become homeowners. And the 0% down is another one that I've heard come up, which I just hate to hear, because there's all kinds of reasons why people might not want to put money down. It's a great benefit to not tie up your cash with a down payment if you don't have to. It may not be that they don't have any money, right? So it's not always an indication of the strength of the borrower. And if they have a VA loan approval, the VA loan is so much more flexible on underwriting than most other loans. People don't realize there's no credit score requirement and there's no DTI requirement on VA loans. It's all manually underwritten. It has to do with the ability to repay, household size, residual money that's left over at the end of the month after paying bills and taxes. So it's different calculations that actually make it easier for people to qualify. I've had people qualify for VA loans with an 80% DTI because they don't have the income and they have the high payment, but they can show that they have the cash flow to manage that based on their other household expenses. And it's a lot more flexible. So I'd love that you brought that up, because that's an important thing that we need to educate listing agents and sellers on.
And I'm going to tell you this is where education makes a difference. There are so many people who have no clue. They're still living in the past. Like, I don't want to touch VA. But then what I've done is have Seth call them directly, and all of a sudden they get educated. So not only sometimes you have to educate your borrower, sometimes you have to educate the listing agent. And the listing agents that don't know it today, there are houses that are going to sit forever. All right. Like right now, Eva and I are very flexible, like 2-1 buy downs, VA, you name it, seller credits. Let's get creative, because that's what it takes to sell a home today.
Yep, perfect. Any other objections that you guys are hearing that I can help you?
I have a question for you, Seth.
Sure.
Who isn't qualifying right now?
Good question. So it's those three pillars, right? Credit, income, and down payment. So if two of those are weak, then people aren't getting qualified. So if they don't have a down payment and bad credit, then they're not going to get qualified. If their income just isn't up to what it needs to be for the DTI and they don't have a down payment, then they're not going to get qualified. If one of those areas, if only one of those areas is weak, we can usually find a program to help them get qualified. To me, the quality of buyers seems to be improving, not just with the financial qualifications, but the quality of their motivation, right? So the buyers that I'm working with now either have been sitting on the sidelines, watching, waiting for things to happen, or for whatever reason, you know, are eager to get into the market because they see things still going up. So I'm working with people that are a lot more motivated than they have been over the last couple of years. The first question isn't always what's the rate, right? If that's always the first question, then you know it's going to be a battle. They're going to shop me on the rate. They're going to make your lives difficult with bringing in another lender at the last minute, whatever it is. So I'm not seeing a lot of those people. You know, there's a lot of investors right now and a lot of people that are very motivated because they see the opportunity. So that's the education that I'm trying to do, is what the market's doing and what the opportunity is to get in. But the people that aren't qualifying, you know, I've got a program for most everybody. It just may take some time to get them there.
Okay, I have a question if I can put myself out there. So I rent, and for the last 2 years, I have worked very part-time because, you know, mom was sick, sister, cancer surgery, I had cancer. So my income shrank during those last 2 years. I really want to buy a house. My credit score is 790 and I have 55,000 set aside for purchasing my house. Could I get into a house today?
I would say that for your situation, we would probably need a no income verification loan, unless you have a regular W-2 job with a job offer that can show what your future earning is. It's very difficult to qualify based on past earnings if they've been part-time or inconsistent. So the biggest strength that, I mean, your credit score is awesome. So that's one positive factor. The other one to round it out, because the income is going to be the most difficult part, would be the down payment. So this type of thing would probably need a 20% down payment. My recommendation would be you buy it as an investment property. You can always decide to move in later, but you can buy it as an investment property with a no income verification type of loan, but that's going to require 20% down.
Okay.
Awesome. Awesome job, Seth. Thank you so much.
My pleasure.
All right. You can stop the recording. See you guys later. Seth, if you have questions, give Seth a call on the outside. And Seth, you recorded that thing yesterday. Was that a live video?
That was live on Facebook. So if you go to my personal Facebook page, it's on there. It'll be there for 30 days, I think, before they eliminate those.
Awesome job. Great job, guys.